All right, Tayga, I lost you on the screen, but do you want to come on and say hello, what's your background, and tell us a little bit about Debite before we jump into things.
Cool. Thank you so much. It's always a pleasure to meet with wonderful entrepreneurs like that. I'm Tayga, CEO and co-founder at Debite. This is my third startup. First, when I built it, it's a very traditional one when I was 19. Sold it when I was 21, made some cash, built up another home services marketplace back in Turkey, expanded into 3 different countries. And while expanding in the UK, I realized that there is a huge need at the B2B financing side, because the reason was I had close to 1.5 million pounds in the bank, and Citibank didn't give us a 10,000 pounds credit card. And I was like, if I'm having this problem, lots of other founders are having the same problem as well. So we are 3 co-founders. We jumped on building a financial control center for early stage companies. What we do is we are helping you to manage your cash flow by receiving your receivables faster and paying your payables slower. We give you a credit card. That credit card can do installments, bank transfers. Basically, we are helping you to spend easier and faster. And then the more products that are coming is going to help you to focus on managing your cash flow as well. Because for me, the most important thing for a founder is managing the cash flow. This is the initial words of Debite.
Perfect. Before we jump into like the B2B sales side, one thing I've noticed about your team, particularly the past 6 months, is you guys are shipping new products and features like crazy. And I'm just curious to know, like, how do you manage the team keep like at that pace? And also, how are you deciding what features to launch and like what's next in your priority list?
I think there are some low-hanging fruits that we are always getting questions from our existing customers about, like they need our help to solve their immediate problem, or we are always checking some data internally. For example, we launched a bank-to-bank transfer from your credit card option for our customers. Why? Because while we were checking their transactions from Debite card, I realized that they were using a company called Billhop. Billhop was helping them to put your credit card in. They're going to do the bank transfer and they're going to charge you 3%. And I was like, we can do it for, I don't know, cheaper, faster, and more efficient. So that we launched the same product for our existing customers. And they started to consume it like crazy. So all our ideas about launching new products, either coming from our customers, or sometimes like now we are building another one, which is going to be a pretty big one in the next few weeks. Sometimes we are thinking about like, what would I do if I have a product like this? So now, as you all know, I think maybe some of you are started to implement like OpenAI or like any other AI thing into your company, which is a groundbreaking thing. We are trying to do exactly the same thing. You guys are the first one that I publicly announced, but we are trying to build up a conversational CFO tool into your Debite account. That means you can, let's say, build up a conversation with Debite's AI bot, and you can send money to your vendors. You can see how much direct debit payments you're going to pay next week, or like, is there any, let's say, opportunity in your cash flow to manage it properly by turning your transactions into installments. So what we are trying to do is, 1, we are trying to understand our customers' need, and 2, we are trying to understand what the current environment looks like. Because as I have a couple of questions from the hotbed team last week, like the questions are going to go for the total addressable market kind of questions, and like the things that you do is basically improve your addressable market in the near future. Whatever you do, it's going to change a lot. And when the questions are coming for that market sizing thing, I think I will give more examples for that.
Yeah, that leads me perfectly into the first question in the set of questions I sent over, which was about, TAM, SOM, and SAM, and how you calculate that and where you see people go wrong. And also, what has been like the pushback you've heard from investors around how you calculated your TAM? But also in regard, given what you just
Yeah.
said, there's more context to add there. So if you want to expand on this,
Yeah.
go for it.
Yeah. Like if you're not flying so high, basically whatever market sizing calculations that you do is going to be small than what you assume in the next 5 years. Check, I don't know, Uber's market assumptions when they first launched their product and what happens to now. So it's going to be like that. But as an angel investor and like an existing founder, what I'm trying to do is I'm trying to focus on a sizable market, and I'm trying to show it to my investors as well, because what they're investing is one, the team, the second, market because of the opportunity, and the third, sometimes if they are super related with product related questions. So I think we did exactly the same thing on sizing our market as well. We go from top to bottom about like how many businesses are in the UK, which we can serve, excluding the let's say blacklisted activities like adult industry, crypto, gambling, or whatsoever. And then we go to one more space on the customers that basically in our target market, because if we are going to serve Debite to an enterprise, I think it doesn't make any sense for them right now. So that we put another layer by saying that, okay, this is the company size around their revenues or around their employee numbers. And then it, like, we started with 2 million and then goes to 1 million. And then we are trying to find like easy and fast approachable market so that we can acquire those like 200,000 customers that we can easily go in from our, I don't know, existing competitors, or the ones that already spending time online and more, let's say, early adopter vibes. So like the numbers are good, but like whatever you calculate right now, 5 years later, hopefully is going to be 10% of what you have. So imagine that. Don't go like we have like a $10 trillion opportunity or something like that, because like I know that lots of investors are making fun of it, but the addressable market calculations are all about like, okay, like can you make money? Like how much of the market is currently taken over by another competitor or like a big, I don't know, traditional high street banks for us, and like what happens if we hit a certain scale like that, we can basically do sizable revenues. This is what we do.
How, I guess, was it challenging given the fact that like if you're building a product where there's existing competitors, you can sometimes see what they had on their initial deck, or you can kind of find out what numbers they're basing it off of. But for you, since companies weren't really using a credit line, how did you go about like creating estimates around that?
So we go about, like what we did is we were trying to at the beginning check how much they are spending and what type of let's say transactions that they are doing with Debite, because our addressable market changed a lot when we understand why our customers are using our products. So what we did is we said, okay, like those are the companies that potentially can use our product, and these are the transactions and the industries that they spend their money. For example, in our case, we are not covering the salary payments. So we excluded the salary payments of all the costs that a company can have. So if they're roughly spending, let's say, £20,000 every month, we just like multiplied it with our potential customer numbers, and then you can see the whole transaction volume that we can get. But the transaction volume is not equal to what we are earning from them, because like how we make money is either from interchange fees, so whatever they spend with their card, we get a commission, or like the transaction fees or the interest fee. So like those calculations at the beginning, like when you don't have a revenue channel, or like when you don't have any existing customers, it's a bit tough. But like I see that my addressable market evolves a lot while we are onboarding new customers, because you see another type of a customer that you can serve so that it goes up, or sometimes while you are making an assumption, it goes down. But I can assure you that if you have a sizable market, the investors are not 100% doing a deep dive into your addressable market and trying to hit you from there. But if you're doing a very specific product for a very niche people, that becomes more, let's say, important. Like if you're building a software tool for, I don't know, kind of a software security or whatever it is, of course, like there are some certain customers that you can get, and not, I don't know, 2 million customers can get it in the UK. But like if you're doing a more a consumer thing, or like have a broader, wider, let's say, opportunity, it doesn't make any sense. It's just like they want to see the big picture, or how you show the big picture. I think that's important.
Makes sense. Is there a minimum TAM size that, let's say like VCs in particular, need to see in order to get interested or excited?
No idea, because it depends on how much money you can make from those existing customers. Like, let me give you an example. So one of my competitor has 1,000 customers, but their customers are mostly enterprises. So they're spending around £1 million per month. And I can go to 10,000 customers, but they're going to spend £10,000. So like, it's all about your business model. And if like, maybe you're going to have, I don't know, only 30, 40 customers, but they're going to pay you $1 million per year. So that market size doesn't mean anything for them. But if you're going to be in a safe side, always like billions of dollars, not trillions, not millions, but billions is always working properly as a like outside eye.
Makes sense. So when you were first going to market, what was the market demographic that you were most confident that you could win over? And how did you figure that out?
Yeah, like if you're doing a B2B business, I think the first one is the network of the founder. This is where you're going to play, because like that's the easiest target, and not all of your friends are going to be okay to use your product at the early days. They're always trying to find and validate your idea with other customers as well. But for a B2B founder, network is the most important thing. And if you cannot start the wheel by finding your friends and relatives, about helping them to solve a certain problem, your go-to-market is going to be a very tough one. That's what I can say. For the consumer side, it's mostly very different, because there are like tons of things that you can do because, for example, a friend of mine in Turkey is doing a AI utility app, and they're only focusing on TikTok, and they're acquiring customers for $3-4, and then now they are making $13 million monthly revenue, which is like 5 people working. So it's all about different things, but it's especially at the B2B side, finding the first 100 customers that they are in love with your product is going to change everything. Because imagine that they only bring 3 or 4 of their friends and relatives into your product, and you're going to grow 3x, 4x in the next 6 months. That's going to build up like tons of value, and that's what we see. Because if they don't like your product and having a bad experience from your product, they're going to be talking a lot about it, and they're going to find a way to affect, I don't know, 10 or 15 more customers not to use your product. But if you can find them and convert them into your early adopters, into brand ambassadors, everything is changing. That's what I see from the B2B side.
I don't know if you know this or if you'll remember this, but of the first 100 customers that you had, do you remember the breakdown of where they came from? Like what percentage was word of mouth or, advertising, email, etc.?
What we try to do is we try to do everything with the pre-seed money that we raised. So we even did an out-of-home campaign. We did like a big sponsorship, some partnerships, some Google ads, Facebook ads, LinkedIn ads, because what we were trying to prove that like there are going to be things that doesn't work for us, and there are going to be things that work for us. So what we were trying to do is we were trying to replicate the things that we already did and find new ways to improve that coefficient number. So I remember that the first, let's say 25, 30 of them was like friends and family of mine. And then once we hit, and you see the adoption, even from your friends and family, like some of them are using it properly, and some of them is like trying to do a favor to you. So like you see like how many of them use it properly and why they are using it, and trying to replicate the same scenario so that you can target the ones that actually need your product. Because like in 2021, I think everything was much easier because like the money was cheap, so that you would bring lots of customers for that. But now I think it's all about like finding the best ways. And if you're gonna offer a product for the businesses in 2021, I think vitamins were working because the money was cheap. Now your product needs to be a painkiller because people are stop spending that much, and we can easily see it in our platform as well, because we are controlling how much they are spending, and everyone is focusing on more, let's say, cutting the unexpected expenses. They're cutting the things that doesn't help them to grow profitably, so that becoming a financial painkiller, in our case financial painkiller, and in maybe their case another painkiller, is the most important thing for businesses.
That makes sense. So when you were pitching to investors, especially at your pre-launch or when you just had a few customers, did you focus more on selling the like TAM or the larger total addressable market, or just the SOM, like your first initial batch of users? Did you do a bit of both? That's something that founders are always trying to, especially in the cohort, are trying to figure out, like, do you go super granular or do you go grand vision?
Again, it's depending on your business model, but what I sold is first to team, which is the most important thing. And the second one is when I didn't have any traction, it was all about the vision that we have. So it's related with the team, but like if you don't have any customers, what you're gonna solve. And when we started to have some early traction, you're gonna find that, let's say, a North Star metric that matters a lot to you. And if you can, let's say, give it to your investor as well, that feeling, and that North Star metric is actually a very magical one, it's important one. They got it. For us, for example, now 75% of our customers are using us as their primary spending channel. And that was the magical thing that attracts most of our investors, because what we saw is like they used our product in a, let's say, very high adoption way. And we were selling that, okay, like we did this by spending X thousand pounds. Imagine that if we have 10x, how many customers that we're going to have and how we're going to improve their life as a vision. So in my case, I was not like a market sizing guy. So I'm always putting it into my pitch deck 100% to show what's going to happen. But my case was like, it's a very simple case. Like there are people are spending their money. So like my market size is, as you can imagine, it was very big. So I didn't need to prove that it was big. So I was trying to prove other things. Like in my case, the most important thing was the risk. So I was trying to prove that my risk metrics are good enough. But it's like super different for every single company.
We use it as our primary spending method too.
Good to see it.
Going back to what you were saying earlier about looking at customer behavior to launch new features, how do you make sure you're not, I guess, like, how do you balance the new opportunities you see with your, 12, 18-month roadmap? Like, when do you know when to divert and create something based off of the feedback, or just stick to the plan?
So like we never do a product that is only helping a small number of people. It's always like there are like lots of things that are having similar patterns from our customers. It's all about talking with your customer, right? Like if multiple of them, like lots of them are asking for the same product feature, you should do it. But sometimes like technology is evolving faster than what you can envision. So you need to read a lot, and you need to make lots of research on how you can implement those new features into your product as well. So we launched like lots of different products super fast because we were not the first mover. So like being a first mover has a huge advantage, because like whatever you do, your advantage and disadvantage, let's say, whatever you do, you're not trying to follow up with someone else. Like you build, which is a hard thing, and people are trying to replicate what you do. But in our case, there are tons of banks and spend management platforms that already did like lots of remarkable things. So what we were trying to do is trying to build up unique products that our competitors doesn't offer, so that we can find some customers that can be attracted by our new products, so that if you and we can build new products that becomes market standards, that's what we are always trying to do. Just an example, so like all of our competitors has a credit card, and now like in the UK, having a credit card becoming a more like a market standard, but none of them has an installment option or like a bank transfer option. So what we are trying to build is, after using our product, we want our customers to go to their existing or new providers, and while they are looking for a credit card, they should ask, oh, your credit card doesn't do installments, why? So like if the new products that you build is becoming a market standard, you are doing a great job. And it's all about building desirable products, right? Like if they are, let's say, changing how people spend their capital, that's a great thing. And that's what we were trying to do.
Thanks. Okay, I want to use the last 10 minutes to talk about like the sales cycle bit, but then we'll move into questions. So founders, raise your hand if you want to ask a question live. So I want to chat a little bit about selling to startups, especially like the difference between when you're selling to a founder, let's say like selling to a founder versus selling to, I don't know, who you would be who would be your point of contact at like a slightly larger startup. Like if you're selling to the head of ops, maybe they have a part-time FD. How do you figure out like the right person to contact?
So like we have two kind of a customer types. One of them, like 60%, is profitable small businesses. So they have multiple options. If they go to any high street banks, they would probably get something, not fast and easy as what they got from Debite, but they have options. When you go for pre-seed, seed, series A startups, they don't have like lots of options, and we are there to help them. So there are two different strategies. So for the startups, what we are trying to do is we are focusing on 5 to 25 people working companies, like Series A and below, so that whoever we affected is either the CEO co-founder or CFO co-founder, so that we are not dealing with the finance managers or like any other people in the team, so that they can get an approval from their directors or CFOs or CEOs, whatever it is. So the sales cycle, because of that, is relatively faster. And what we see is there are lots of really good fractional CFOs in the market right now that is dealing with multiple other companies. And if you can go there, you're going to have a really good, let's say, growth tech, because you can, like, while having one fractional CFO, you can get 10, 15 more customers as well. But for the, let's say, SMEs, the sales cycle is a bit longer because they can have other options as well. So that you need to prioritize them and give them a feeling that they don't get from Barclays or Santander or NatWest or like whoever it is. So that those two options are pretty different strategies. And we are lucky that we can see who is who and how we should approach to both different segments. I think one of our blockers is to go to the higher end of our customers, because if you're dealing with Series B company, there's going to be a CFO, there's going to be a finance team, so that the sales cycle is going to be relatively longer. But it doesn't mean that the companies that are here is going to have a problem when they have a longer sales cycle. Why? Because the longer that it gets, basically the retention is going to be so high, because if someone comes in to replace you, basically they're going to have the same problem as well. So you can use it into your advantage as well. But in our case, I think we go for a very, very short cycle, because imagine that no one is offering you a credit card and now you have an option to get it. So basically, it's, for us, a couple of days sales cycle.
Was it challenging, especially when you first launched, to build up trust with, you know, considering it's like a financial product, has credit, all that fun stuff?
I was thinking that there's going to be a big barrier in front of us. But what we do, like, let's say tomorrow we go bust, what's going to happen to you is basically nothing, because we give you the initial money. You don't put your own capital inside of our platform, and that is actually covering you to protect yourself. And we don't have lots of barriers in front of us, because there is no risk for the customer. The risk is in our end. So what I see from the existing neobanks or like spend management guy, their initial phase was always so tough because they were trying to hold the customers' money. And imagine that if you're like a 6-month-old company, why they're gonna trust you? But in the end, it's a very like a less capital efficient progress for them as well. Like we are always raising more capital to put it into our customers' credit cards, and it's always like have some limitations. We cannot onboard thousands of customers even if we have in the wait list.
That makes sense. And what was the investment like fundraising process like in a more regulated market? Did you have challenges around that?
I think the biggest challenge was one, the risk side, because like whoever is in this call right now is potentially our customers. But in the meantime, 9 months later, hopefully they're going to be all successful, but there's a huge potential of going bust, or not even going bust, deciding not to move forward with their own idea. So that was the issue with our investors as well. We were trying to solve that by having very strong competitors as well. Like our competitors are Brex, Ramp, Unimos, Jeeves, and when you combine all of them, their market cap combination of all of them are around like $30 billion, and like they have raised, I don't know, in total $3-4 billion as well. So that was the hardest issue for us to say that okay, they are doing a great job, but we are also doing a great job. The market is big enough for us to serve, so that even if they're like spending so much money and having lots of customers, they're only serving, let's say, 0.5% of the total market. That was actually helping me a lot to convince the investors, because they were talking about how successful those companies are. And when you combine all of their customers together, it makes in the UK 6,000 customers. And in the UK, our market is around 2 million customers. So like we were trying to show them that, yes, there is a competition, but that competition is only covering 0.5%. The real competition is with the high street banks, the big banks that they're not doing their job well. And this is like, if you have a very competitive landscape in your startup, I think this is what you should focus. If there's a huge competition, there should be a huge market as well, so that you can jump in, because like we are not always so lucky to be the first mover.
So it's not always a bad thing to have massive competitors or big companies in your space.
If you have a big market, yes. But like if you already have a small market and very successful competitors, it's going to be really hard for you to be there and raise more capital, especially in this economic environment.
Makes sense. Just going back to the sales bit, you mentioned targeting people with the co-founder, CFO job title. Is that is most of the outreach there on LinkedIn, or are you also like doing emails as well?
Yeah.
And then just like the message to figure out the right selling point?
Yeah, I'm always trying to build products that promotes themselves by like standing alone products. So what we did, for example, while you are doing a bank transfer from your existing credit card limit, you need to write down the recipient's email so that we can send the receipt to the vendor or merchant, so that they would know that the money is on the way, because that's what people do. So while we were sending the receipt, that's a perfect opportunity for us to promote our product, because we are always saying that, okay, this is paid by Debite Pay. Here is your £300 cashback. You can apply from here. So like that's not creating a crazy demand with 100 customers. But if imagine that you have 10,000 customers and they are making 10 transactions per day, and then like you're promoting your startup into those merchants as well, and there's going to be a social validation as well, because like one of their customers or vendors are using Debite, so why don't they use Debite as well? So doing all of those small things add up together, and if you do 5 things that create you 1% each improvement in your sales cycle, conversion rate, or like having more customers, it becomes 5% every month. So like I'm always focusing on those things, but we did tons of LinkedIn outreach. Every week I'm trying to write like a small article, either explaining what Debites do, new products, or sometimes not even for customer acquisition, sometimes acquiring new talents is super important as well. So that I'm trying to be there and show my experience about what I did for Debite or for my previous company, and they can be in this environment. So like being there for your customers is super important, because like all of you guys are, I think, spending a couple of minutes every day in LinkedIn. And if you can see a consistent ad, which is not an ad, like an article about someone who you are thinking to use, always adding you up. We always use some tools to identify who can be our customers, from starting from Crunchbase to a couple of different UK, but like Horse or something like that. So B2B sales cycle is all about building relationships, long-term relationships, and then when they need, I think they are converting easier. That's what I realized from my 1 year experience.
Okay, this is my last question, and it's nowhere close to anything we sent you on the question sheet beforehand, so apologies. But how have you thought about branding? Because Debite has a really nice brand. You guys are a young company, and it doesn't seem, it's like the opposite of all like the corporate-y Barclays Bank stuff, but still seems like very professional. How did you, or what was like your thinking process behind that?
Yeah, I think two things. One, 50% of my team was working with me from my previous company, and it was a consumer business, so that we knew what we were looking for and how to attract consumers. And B2B is a very complicated scenario, but if you are trying to convince the people that are, let's say, decision makers, basically it's a consumer business as well. So that's why we knew what we could do, because we pretty much had the same customer base from my previous company and this one. But the other one, as you realized, like the banks are so boring. They're not doing their job properly. And we were trying to find, let's say, opportunities to beat them easier, faster, and cheaper. Branding was one of them, because we know that if you want to go to have a problem with Barclays, or like your Barclays, let's say, account executive, it's a boring situation, and it's like let's say, it's stressful, because those guys are so high, they don't understand you, they don't care about you, they don't give an SHIT about you, because like you're small. Like if you're like I don't know $100 million revenue company, then you're becoming more important for them. So we realized that there is a low-hanging fruit on that. If we can focus on our branding, we could be the one who's helping other founders and being there when no one cares. And if we can build that product and brand together with our growing companies, I think it's going to change on time. But now it's time to be there as a very familiar and friendly face, and helping them wherever we can.
Okay, I'm going to take Annie's question from the chat, and Mikhail will go to you. And if you want to add any context to this as well, feel free to take yourself off mute and ask it. But she's written, should you calculate the service, the SOM, the service addressable or obtainable market of the market share in a certain period of time?
Nice question, and I never thought about it. Should you calculate some of the market share in a certain time frame? I will get back to this at the end of the conversation when I think about it a bit.
Thanks, Tayga.
Okay, Mikhail, we'll go to you.
Hi guys, Mikhail from Alpha Sales. We build a digital sales notebook with personal assistants. Very nice conversation, good questions, and very interesting answers. So you mentioned pre-seed funding you've received. So my question is, at the time of the very first funding you have received, can you tell us about the traction you had specifically? So what was the number of users?
No, I didn't even have the company when I first raised my pre-seed round, because pre-seed is all about who you are and what you're dreaming of. And if you achieve something before, you need to sell that one as well. So what I did is I closed the pre-seed round in 7-8 days, because like I had my previous investors as well, and some new ones that already see my previous company and said, I want to be there. So what I structurize it, okay, I need money to build my product. And when I build the product, it's going to have a great adoption. And this is what we are trying to build, something that other customers are desiring. That's what we are trying to do. And when we realize that, okay, this is actually working and people are using it, now we need to replicate the things that have worked so that we can go raise our seed round. And then we can focus on the things that have worked before and trying to achieve product market fit. But if you didn't, like, if it's going to be your first game, I know how hard is it. So that is always good to be in an accelerator, because you can acquire lots of customers, initial customers, let's say, by not spending so much money, and you can focus on bringing the network effect of the accelerator and the people around it. So I know it's hard, but pre-seed is not about numbers. Like if you're going to talk about, let's say, customer acquisition cost, because you're not going to spend £50,000, £100,000 per month, the customer acquisition cost is not going to be a reliable thing, because I don't know, you already spent £700, and then you're going to have a relatively lower customer acquisition cost. But the investors are not going to look for it. The investors are going to look for your market size, your vision, and who built a company in the same field before, and who, the most importantly, who you are.
Good, thank you.
You're welcome.
Good question from Ewan in the chat. You said you've seen customers / startups reducing how much they're spending, but as a startup, it's great to always be lean. So where specifically have you seen these customers cut their costs?
Nice question. So the startups are always like, they need to be lean, but in the meantime, they need to do lots of mistakes as well. So those mistakes are going to help them either to grow faster or like learn new things and not to do the same mistake. So what we saw is the most three common industries that people spend money is: one, digital ads; the second one is SaaS subscriptions; and the third one is tax payment. So you cannot decrease your tax payments because the government still charge you the VAT, pay or whatever it is. But SaaS subscriptions and let's say digital ads are affected a lot over the last 11 months. That's what we see, because the investors right now are putting pressure on startups that if this is not working, you need to be fast and take measurements and not focus on doing something else. We were seeing lots of SaaS subscriptions that the customers are using it and trying new things and having sometimes two similar products at the same time to see like which one is working properly for them. But now we see that they started to eliminate the other ones and focusing on, let's say, they could spend more time, their founders' personal time, on the methods that a SaaS subscription solves for them. So like becoming a painkiller is should be a top priority for especially SaaS businesses, because if it's a vitamin, the founders are looking for switching it off for a certain time until they raise more capital or like having a more sustainable business.
Do you think it's possible for a company that is positioned as a vitamin to reposition itself as a painkiller or add a few features? Or do you think that's something that's like at the core of a startup and not something they can pivot to or easily reposition?
Yeah, I think it could be done. But I'm trying to find a company that has already done it before, and I can give you an example of like it started like a let's say vitamin and becomes a painkiller. It's really hard for me to say who did it before. Of course, there could be some potential things, but 2020, like late 2020 and 2021 has shifted this like fundraising game a lot. We saw lots of companies that potentially doesn't have a big revenue opportunity, and they're not like building a product that solves an immediate problem, and they raised hundreds of millions of dollars, and we start to see that they are doing a massive layoffs or they're like shutting their companies down. So it's hard, and I don't suggest, but if you already started as a vitamin, because I don't know, it's just not, this is what the idea that you have, you always need to find a way to to be more efficient. And for Annie's question, that's what I was thinking, because this is a question that investors are always relatively asking. It's like, we put our sum as 200 customers with like early stage startups, because we were thinking that pre-seed, seed, Series A startups are going to have a massive opportunity. They're early adopters. They want to have a technology game, everything. But we realized that it changed over time. And when we have SMEs as well, our market started to grow, because we were not expecting profitable, like small businesses are going to use our product. We were always going for the cash burning VC-backed startups, which is cheaper to, let's say, acquire, but has different needs. And in the last 11 months, it changed. So if you're trying to calculate that, yes, like certain time frame, but your company stage is important as well. That's what I can say.
Makes sense. Okay, Kabalin, I'll go to you first, and then Simon, we'll go to you afterwards.
Thanks, Sam, and thanks, Tayga, for the presentation. Kat Gaspard, building Data Posty, a SaaS platform that allows companies to safely monetize their data. So, Tayga, you mentioned that step one in B2B is reach out to your network as a co-founder. You also mentioned that you do sometimes have to spend money on paid ads like LinkedIn, Google, and so on. Did you start both at the same time, or did you pick up a certain amount of traction through your network first before starting to pay for online advertising?
I'm always a low-hanging fruit type of a guy. So like if I have people that is around me who can use my product, I first always go to them, build up the traction. And it's a great way to say, I didn't spend like any dollars or pounds to acquire more customers. These are the ones that already wants to use my product. But like the most important thing for you should be the momentum, so that you versus waiting for your friends to use your product versus spending money on getting more customers. I would spend money and get more customers as well, because like none of the pre-seed or seed or Series A investors are going to say, why did you spend that much on growing? Because if you're growing, you solve the problem. Growth basically solves a lot of problems. But if you can do it, it's just like a strategy. If you can acquire same number of customers without spending any money, why are you spending money? That's my approach.
That's clear. Thanks, Tayga.
You're welcome. Great.
Simon.
Hello. Yeah, loving this conversation. Thanks very much. So I'm building Blocks. We're a SaaS platform to help leaders with financial planning and modeling. So if you're and actually my question is about this. So we've raised we raised 600K so far on pre-seed and spent half that already. And so I'm basically trying to figure out, how do you think about how quickly you keep spending, burning? So I feel like we've built the team, we're running fast. I can keep running at this pace, which I want to. Everything says like, yes, run fast, but I just don't know if I'm going to get another round in with all the right momentum, all the right metrics to be able to raise without hitting the end of the runway. So it's this season of like, okay, do I keep going? Do I just trust my gut? Like, how do you think about that? Yeah. Or would you just cut back and sort of just really look to extend runway? What do you think?
Nice, very nice question. How did you build up your investor relationships before? Like I think that's important, because like if you build up a really good pipeline for your seed investors while raising your pre-seed round, and you keep sending them updates and making them excited and communicated, that's something different. So that when you spend as you assumed and growing fast, you can always say to your potential customers that now I'm planning to raise money and I'm going to close it in the next 3 or 4 weeks, because like everything is going great. But imagine that you didn't build up those relationships so far, so that you're going to be no one when you first approach, and you're going to say, I want to close it in the next, I don't know, 1 month, 2 months, or whatever. So it's going to be hard. So if you already build up your connections before, I think I wouldn't stop spending as what you were spending before and keep on hitting the targets. And then I think it should be in September or October, because what I feel is September, October is going to be a tons of funds looking to invest more companies, because they're going to be out in August, and like July, August is going to be a slow one, but people are going to be there. So if you can go until September, October with good numbers, I wouldn't do it. But if you don't have the pipeline yet, I would cut it and start to build up those relationships and then have a longer runway. This is my 1 cent.
That's great. I appreciate that.
Great.
Good luck.
We have a fair amount of startups in the cohort who are SaaS startups, but are selling B2C. And with your last company, I don't think it was SaaS, but I know you mentioned that it was consumer focused. Are there any sales strategies that you have? And I know that's general, because obviously consumers, like, that's a massive group and it varies quite a bit. But anything that's incredibly different from selling to startups that you'd want to highlight?
I think for SaaS companies, it's all about the formula. So my formula for the consumer businesses are like, you're going to have 3 types of acquisition channels. The first one is going to be the most effective one. So that could be super expensive. The second one is going to go for a higher number of customers, which is the higher traffic. And the third one is going to be, let's say, the most efficient one as a customer acquisition cost. So as a pre-seed or seed level startup, what you should do is to combine all of them together, not to focus only one of them, and always mix it up while you're trying to acquire more customers. Because the most, let's say, high value of it, the first one, the highest value of customers are going to be the highest, let's say, acquisition cost, and the more traffic should be low cost, and the more efficient should be a combination of those two. So I think mixing your acquisition strategies is the most important thing, because once you hit Series A, you're going to do whatever it was, like, you cannot try new things. You should always focus on numbers, because Series A to Series B should be all numbers game. So it's going to be, you don't have a chance to do mistakes. So try as much as you can, find new opportunities, and find out the ones that are working properly, and then mix it up together. That's my general view on consumer acquisition side.
Great. Okay, I have a follow-up question on that. But Marco, we'll go to you first.
Hi, Tayga. Very interesting session. I just wanted to ask you your opinion on the balancing act between, the runway that you're targeting with a round versus the amount of equity you're giving, especially if you have a certain, sales pipeline and you're trying to sort of optimize the like, obviously you don't want to raise next month again or something like that, but like, what would be the minimum runway that you would target in a raise, in a round?
I think minimum 16 months. But
16
whoever
months.
whoever I talk with the seed investors in the UK right now, they're asking for 24 months when you raise a seed round. Now that's the perspective that most of the seed investors are asking. It was, let's say, relatively shorter 2021 and 22, and now they're looking for a longer thing, because they know that Series A and B is relatively slower. CDE is like that, and IPO market is also that. So that's what they are calculating. But I think this is going to change next year, hopefully. Like there are tons of dry powder, and always raise money when you don't need it is the most important thing, because like even how you sit on the chair while talking with an investor is changing. When you have enough capital in the bank, you become more confident. You don't need them. You need their money to grow faster, and this is why you need to raise money, I think.
And in terms of equity, so sort of if you have an option, for example, of raising, like in the current, okay, so let's say the investors insist on 24 months, right? That's what you're saying. So they are saying you need at least 24 months, right?
Exactly.
Okay, so let's say you have that option versus a longer option because you don't want to raise again soon. Like how would you balance that against the equity? Like how much equity do you really want to have when you enter Series A?
It's all depending on your company structure, how many co-founders you have, how many advisors you have, how many stock options that you created. But my suggestion for pre-seed is 10 to 15% dilution, and seed 15-ish dilution should be okay. Because like if a sizable VC who wants to lead your run needs at least 10% of your business. So that like going over 20 is which I won't suggest. If there is like a huge opportunity from 15 to 20, I would be okay for 20 because I don't want to raise more capital in the near future because of strategic reasons, but I wouldn't go above 20.
So when you're saying that, okay, so pre-seed 15% and then the seed 15, so that's 30 total, right? That's what we're saying.
Yes.
Oh, okay.
But like there are lots of, let's say, outliers as well. I think everyone saw the AI company that raised its seed like $100 million and diluted 46%. So
Yeah.
like there are lots of other things as well, but it's all about like what you're looking for. Are you going to be profitable after giving 30% of your business and you're not going to need any money from VCs anymore? Yeah, like dilute however you want. But if you're going to be in the game, like a VC game that you're going to play, that's how it should be, I guess.
Okay, thank you.
You're welcome.
Question from Joe. If you've already made those mistakes on dilution, how do you recover the position / founder shareholding? Do you go into the options pool? I think
it's hard. It's really hard because like you already gave up. It's not only for the shares as well. It's related with the terms that you gave away as well. Because if you gave terrible terms on a seed round, the Series A investors most probably is going to start from that level, and you're not going to be able to get the terms back if you're not in a very strong position. So what I could do is I can talk to my board, if I have a board, or like shareholders, by putting lots of, let's say, really passionate goals. So if I can hit those goals, the company is going to be highly affected, positively affected by reaching up to those goals, so that I can put some, let's say, bonuses or like either cash-based or stock-based bonuses into my management team's, let's say, compensation. I think the most successful one who already did is Elon Musk with Tesla. So like he was asking for a really crazy valuation, and if they hit that valuation, he's going to be compensated, I think, the highest compensation of the world so far, and he did it. So like you need to be extremely successful in order to solve that problem.
And then Jeff followed up and said, what are terrible terms? I mean, we covered a little bit of that, but is there any other specifics that you've seen added to the term sheet?
Let's say out of market liquidation preference terms, that is affecting your next fundraise as well. Some, let's say, expense limitations, like if you're going to spend more than £10,000 for a single vendor, you need to get a signature from one of their investors, and sometimes it really affect your momentum because they'll not always be there to help you because it's not their primary job. There could be any voting rights about raising a new fund, or what else it could be. I think these are the main things that I have in my mind.
Okay, that makes sense. And then the follow-up question I had from what you talked about with the B2C acquisition, if you're trying a lot of different marketing methods at the beginning, how do you know which one is responsible for working? I mean, obviously there's some cases that it's much easier to tell. But how can you figure it out?
If the tracking should be really important, like how you track your traffic, where are they coming from, tagging them, etc., and you retarget them, whatever it is. That's the technical side. But if you're in the early days, like whoever comes in to use your product as a consumer, you need to talk with them. Like that's the most important. Like, why did they choose you? Why are they keep on using your product the next month? What makes them interested in your product at the first place? Like those questions you need to ask. And if your customers are dealing with the CEO, the founder, they're always willing to give more information so that you can build your strategy on top of it. So when I was working for this one, I'm talking with everyone because it's a B2B product and I need to talk with my customers. But even for the consumers, I was doing the customer success job, solving the tickets. If there's a problem with the house, I was dealing with it to understand either problems for my suppliers or for my customers as well. Talking, asking, and using the technicalities, of course, like if you're a B2B business, use hockey stack. If you're a B2C, if you have money, Mixpanel, Google Analytics, tons of options that you can check.
Great. Okay, last question. I know half your team is based here and half of them are in Turkey, I think. How do you manage like being a high growth startup with a team spread out? I mean, at least you're like so close together, but it seems like now everyone is saying you have to be in the office all together, and remote doesn't work for startups.
For me, remote is super hard. If you're not a developer, you should be at the office. Not 100%. Sometimes people are being more efficient while working in a room that no one is in. So we are allowing people to be in their homes and like work however they want. But like if you have a really good, let's say, vibe in the office, they are always wanted to be there because that's where you take decisions and you have a fast pace. So people are feeling like if they're not at the office, they are missing something. So they don't want to be missed out. They want to be in the control center. So that's why they're always coming in. Remote for me, if I'm working remotely, I couldn't do it. Like I'm not the guy who can do remote work. But there is a huge opportunity on cost side, having some software developers back in Turkey. So some of them, for example, now rented an office for themselves. Our CTO rented an office and inviting his teammates because they don't want to be apart. So eventually, I think it's going to be an optional thing. We are not going to say you have to come to the office, but if you're going to be there, you're going to be a part of the management team, and that's what people like. And if they still don't want to come because of I don't know, if there's like a big problem or like they are living outside of London and they cannot come to the office and they are preferring not to come, maybe they are not the right people. That's what I feel.
Great, some FOMO. Okay. And quickly before we end, founders, if you go on the member portal, we've mentioned this before, but there's a special deal if you want to sign up for Debite. You get, I believe it's £200 cash back. And yeah, all the information is on the site under the resources tab, I believe. Okay, we're gonna now, Tayga, thank you so much for joining us. Where's the best place that people can find you and find Debite?
Debite is debite.io, very easy. For me, I think either Twitter or LinkedIn, I'm trying to be very active. Whoever sent me a message, I'm trying to be as much as responsive that I can be. I will be in your demo days, events or whatever it is, so we can meet face to face as well. And I'm based in London, Soho, so whoever has a thing to do in Soho, always send me a message and let's grab a coffee.
Great, thank you so much. Okay, founders, stick around. Tayga, thanks. And
thank you so much for having me here.
Great, awesome.